Good morning, sir. Saran sir, good morning.
Sir, good morning, sir.
Very good morning.
Am I audible, sir?
Yes, sir. Yes, sir. Audible, sir.
Yes, sir. You are audible, sir. Sir, what about the remaining people, sir, from our swim?
Yes, sir.
Sir, sir, good morning, sir.
Sir, good morning, sir.
Can we share it, sir?
Sir, already I have sent a YouTube link to you, sir. Sharwan, sir.
Zoom, sir. Zoom. Yesterday, whatever you have sent, that one, sir.
Yesterday itself we have sent it, sir. Zoom credentials.
Sir. I'm just pasting it to you, sir. Just confirm it, then I will send it to you.
Yeah.
Is this okay, sir?
Yes, sir. Yes, sir. That's one.
This is for Zoom.
Zoom, sir.
And for WhatsApp, we have whatever you have sent. Sorry, YouTube, sir.
Yeah, YouTube. Yes, sir. I think that YouTube link is working, sir.
Yes, sir. Yes, sir.
Okay, sir. Fine, sir.
Balaji, sir, can you please go to the YouTube link and check whether I am visible?
YouTube link, sir.
Yes, sir. Yes, sir.
Sir, YouTube, share YouTube link, sir.
1 second, sir. 1 second.
Sir, we can directly go to stream now, sir. Stream.
Yes.
View stream on YouTube.
Just check this, sir. Balaji, sir.
Sir, you can just click that link, sir. That's enough, sir. You directly redirect to the YouTube channel.
Okay.
Hello. ఇచ్చేసాను సార్ క్రెడెన్షియల్స్ ఇచ్చాను సార్ yes sir అలాగే
Is it okay, sir? Balaji, sir.
Sir, 1 minute.
Okay.
Sir, Saranan, sir.
Sir.
మీరు వాట్సాప్ లో పెట్టారు ఆ లింకే కదా సార్?
ఓకేనా?
మన ఓకే మన పార్టిసిపెంట్స్ కి లింక్ అయినా సార్ ఫార్వర్డ్ చేయాల్సింది?
అవును సార్. ఫస్ట్ మన స్టాఫ్ పెట్టేస్తాము.
వర్క్ అవుతుంది సార్.
సార్ యూట్యూబ్ లో మనం ఉన్నవాళ్ళు మ్యూట్ చేసుకోండి సార్. ప్యారలల్ గా జూమ్ అండ్ యూట్యూబ్ లో ఉన్నవాళ్ళు.
ఓకే.
I'm putting it in staff, sir. I'm asking them to join Zoom, sir. Balaji, sir. నీ వస్తుందా?
వస్తుంది సార్, వస్తుంది.
చూసుకుంటున్నారు కదా? కరెక్ట్ గానే ఉంది కదా?
వాట్సాప్ లో యూట్యూబ్ లో పెట్టా. వెల్కమ్ యు ఆల్ టు ద టుడేస్ వెబినార్ ఆన్ కమాడిటీ డెరివేటివ్స్ మార్కెట్ ఏ కంప్లీట్ అప్రోచ్ అని కూడా పెట్టా.
Okay, okay. Chat. Okay, very good.
Yeah.
ఇప్పుడు మునిశంకర్ సార్,
ఎస్ సార్.
మనం ఇప్పుడు చాట్ వేసినప్పుడు కొత్తగా జాయిన్ చేసిన వాళ్ళకి కూడా తెలుస్తుందా సార్? న్యూ పీపుల్
తెలుస్తుంది సార్. వచ్చిన వాళ్ళందరికీ తెలుస్తుంది సార్.
ఓకే, ఓకే.
మనము ఆ మెసేజ్ ఒకటి పెట్టాలి సార్. వన్స్ వాళ్ళు పార్టిసిపెంట్స్ వచ్చిన తర్వాత ద పార్టిసిపెంట్స్ హూఎవర్ ఇన్ ద YouTube channel, please kindly mention your name and his institution and designation and register mail and phone number. సో ఈ మెసేజ్ మనం పంపించాలి సార్ వాళ్ళకి. నేను శాంపుల్ ఒకటి మీకు ఇక్కడ మనకు ఇప్పుడు దీంట్లో పెడుతున్నాను సార్ యూట్యూబ్లో. ఒకసారి చూడండి సార్. ఫర్ ఇష్యూయింగ్ సర్టిఫికేట్ పార్టిసిపెంట్ రిక్వెస్ట్ టు ప్రొవైడ్ ద ఫాలోయింగ్ డీటెయిల్స్. నేమ్ ఆఫ్ ది పార్టిసిపెంట్, నేమ్ ఆఫ్ ది ఇన్స్టిట్యూషన్ ఆర్ కంపెనీ.
నేను కూడా సైన్ ఇన్ చేసుకోవాలి కదా సార్?
ఎస్ సార్, ఎస్ సార్.
Good afternoon, sir. Good morning, sir. Karim sir, good morning.
Can you unmute Karim sir also?
Yes, yes, sir. 1 second, sir. I'm doing so. Yes, I have done it. All unmuted, sir. No problem.
Karim sir is
audible.
Yes,
now
sir, yes,
I can talk, sir.
Sir, once the resource person can join, we will assign co-host credentials to the all faculty and
Sarvana sir. Sarvana sir.
Okay, sir. Sir.
That message, whatever message is there, you put it chat. Our group,
sir, already he has pasted, sir.
WhatsApp. WhatsApp లో పేస్ట్ చేయండి, మేము కూడా పేస్ట్ చేస్తూ ఉంటాం సేమ్ చాట్.
ఓకే, 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 ఓకే.
WhatsApp పంపించండి కామన్ నంబర్. We will open YouTube and we are also going to paste the chat.
Sure, sir, sure.
Good morning to you all.
Good morning, sir. Good morning.
Good morning.
Karim sir, good morning.
Good morning, sir. Good morning.
Balaji, credentials 9:45 తర్వాత అంటే మన గెస్ట్ జాయిన్ అయిన తర్వాత
ఓకే సార్
షేర్ చేస్తే బాగుంటుంది.
ఓకే సార్. యూట్యూబ్ లింక్ యాజ్ వెల్ యాజ్ జూమ్.
ఫస్ట్ జూమ్ వేసిన తర్వాత ఒక గ్యాప్ ఇచ్చి కొద్దిగా మళ్ళీ యూట్యూబ్ లింక్ 10 o'clock కి యూట్యూబ్ లింక్ పెట్టేసి 9:50 కి ఇది పెట్టు, తర్వాత 10 కి యూట్యూబ్ లింక్ పెట్టు.
ఓకే సార్. ఓకే సార్. స్టార్టింగ్ టైమ్ ఇస్ 10 o'clock సార్ అవర్ సెషన్.
అవును. అంటే ఆ లోపల వీళ్ళంతా జాయిన్ అయిపోతారు కదా.
What we are thinking after is first at 9:45 our speaker will join, sir. After joining the speaker, immediately we post the YouTube link as well as Zoom link to in the WhatsApp groups.
Okay.
Karim sir, whatever I have pasted came in the chat.
Sir, I will join through YouTube, sir.
Please, sir, please. You have both. You please put it in mute, sir. YouTube, you put it in mute.
Okay.
Balaji.
Sir.
Ready చేసుకున్నాం అంతా?
Yes, sir. Yes, sir.
Okay, no?
Prepared well, sir.
Okay. Sarvanan.
Sir.
Sarvanan.
Sir. Please tell me, sir.
Good morning.
Good morning, sir. Good morning.
How are you?
Very fine, sir.
I think I am not expecting that you are fine, because even midnight also we have taken some risk in way of forwarding mails for latest participants who joined late hours.
Yes, sir. Yes, sir.
But anyhow, we crossed 1,000 1,000 participants registrations. I congratulate you and Balaji also.
Sir, thank you, sir.
And our outstanding reputed staff. Very nice done for registrations. Everybody involved. I ever grateful to each and every staff member.
Sir, good morning, sir.
Good morning.
Sarvana sir, message is visible.
All the best, sir.
I am
All
one
the
of
best
the
for your
coordinators.
webinar.
Sir, Venkat sir, good morning.
Good morning.
Sir, good morning. Good morning to all, sir.
Good morning. Good morning. Sir.
For issuing
Sir, all the best
e-certificates,
for your webinar, sir.
Thank you, sir. Thank you, sir.
For Karim.
Karim, sir.
Karim. Good morning. Come on,
Yes,
tell
sir.
me.
Sir, good morning, sir.
Good morning. Tell me.
Sir, good morning, sir.
Karim, sir, that message, is it visible for issuing e-certificate?
Yes, visible.
Okay,
yes,
okay.
Visible, sir. Once again, I will repeat the messages, whichever are visible.
Yes. Sir.
Last message is, I am one of the coordinator of this program.
Oh my goodness, okay.
And I will be available for any of your queries.
Okay, okay, sir.
First is Balaji, second
Sir.
is Swimd for issuing of e-certificates.
Okay.
Last message from me, sir.
For you is, I am one of the coordinators of this program.
For issuing e-certificate, that has not come?
Not come, sir.
Oh, that means somebody else has to paste, sir. You please paste, sir.
Same matter I will paste again, once again, sir. You just see, huh?
Better, sir, better.
And if it is visible or not, you just tell.
Sir, you paste this message, sir. Karim, sir.
I pasted, sir. Is it coming, sir?
It is coming, sir.
For issuing certificate, yes, sir.
Again, you have to paste every 15 minutes on, sir. I will remind you.
Yes, every 15 minutes. Feedback link also you send to WhatsApp group, sir. Ours.
Okay. That I.
Sir, Sarvana, sir.
Sir.
ఆ సెంటెన్స్ ఫామ్ చేసి పంపించండి, మేము దీంట్లో పేస్ట్ చేసుకుంటాం. ఎక్కడ ఒక వర్డ్ ఫైల్ లో పేస్ట్ చేసుకుంటాం. దెన్ వి విల్ పుట్ ఇట్ ఇన్ లాస్ట్ మూమెంట్.
I am sending you that feedback related stuff, sir, but don't paste it now.
No, we will not paste. It will be only in which one? Word file లో పేస్ట్ చేసుకుంటాం. Later we will paste it from here and we are going to paste it then.
At the end I will paste it, sir, by mistake.
Yes.
Problem.
అంతే.
Balaji, sir.
Sir.
Did you paste this in this one group? You will paste it around after 10 minutes.
In our group, I pasted, sir.
Okay.
Again, I will share all these credential in our 5 groups, sir, WhatsApp groups.
Okay.
Sir told that up to 9:50 we will allow the Zoom participants. After 9:50 we will post in YouTube.
Okay.
That is WhatsApp.
The commodity 3 లో బాలాజీ సార్.
Sir.
ఇదే కదా డియర్ సార్ మేడం గుడ్ మార్నింగ్. అదే కదా పోస్ట్ చేసింది.
మార్నింగ్ సార్, మార్నింగ్ పోస్ట్ చేశాను.
ఇప్పుడు వేరే ఏం పోస్ట్ చేయలే కదా?
చేయలేదు సార్, చేయలేదు. ఎందుకంటే 9:45 స్పీకర్ జాయిన్ అయిన తర్వాత
ఓకే
పెట్టమన్నారు సార్.
Balaji sir,
sir.
I'm pasting one message to you.
Okay, sir.
WhatsApp group lo petteyandi.
Okay, sir. Now it's up, sir.
No, not now. After you paste the Zoom link and YouTube link, that time you can paste.
Okay, sir. Okay.
Participants joining through YouTube provide the
Okay.
following details in chat box with regard to issuing e-certificates.
Okay, sir. Okay.
Check చేసుకోండి sir.
Okay, sir. Please.
ఒకసారి
Yes, sir.
if you go to your this one, you can check.
Yes, sir. You forwarded the details, sir. Participants joining through YouTube provide the following details in chat box with regard to issuing e-certificates: name, institution name, registered email, WhatsApp number. Yes, sir. Got it, sir. Got it.
So first you need to paste this Zoom details and then YouTube details. That particular message.
Once our speaker joins, after that the two things need to be forwarded to groups.
Yes.
Okay. Thank you, sir.
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 ఇక్కడ ఇంకొక ఫర్ ఇష్యూయింగ్ ఈ సర్టిఫికేట్ పార్టిసిపెంట్స్ ఆర్ రిక్వెస్టెడ్ టు ప్రొవైడ్ ఫాలోయింగ్ డీటెయిల్స్ ఉంది కదా, ఇన్ చాట్ బాక్స్ అని యాడ్ చేయండి. ఇన్ యూట్యూబ్ చాట్ బాక్స్.
Yes, in chat box it already provided, sir.
In chat box.
In chat box with regard to issuing e-certificates.
Balaji sir.
Sir.
Need to again send it to Zoom staff. మీరు కూడా ఒకసారి చెప్పండి. Ask our staff to join. 9:40. మళ్ళీ ఒకసారి మెసేజ్ పెట్టండి.
Sir, okay, sir.
Already we have given.
సార్ ఫోన్ చేయనా నేను? సరవణన్ సార్.
సార్
మన టీంకి ఫోన్ చేయనా, మన ఫ్యాకల్టీకి జాయిన్ అవ్వమని?
లేదు సార్, లేదు. They will join.
ఓకే, ఇంటిమేట్ చేయొచ్చు సార్.
సుదర్శన్ సార్,
డైరెక్టర్ సార్ ని ఇంటిమేట్ చేయొచ్చు.
ఓకే.
స్పీకర్ should join sir. సుదర్శన్ సార్.
Sir is not there, sir. Sir is in mute, sir.
Maybe May is interacting with the speaker. Maybe we need to call Gunnar Naidoo sir.
Okay. Can I call, sir?
Sir. Speaker has joined.
Yes, sir. Sir, join.
So welcome, sir. Good morning.
Sir.
Srikanth,
Good
sir.
morning.
Good morning. Munishankar, sir, you may need to unmute.
Good morning. Good morning.
Srikanth, sir.
Session join on, sir.
Good morning, Srikanth.
Sir, మన గ్రూప్ లో సార్ మీకు ఫార్వర్డ్ చేస్తాను సార్.
So exactly 9:45 you have joined, sir. Srikanth, sir.
ఓకే సార్, మెయిల్ పెడతా సార్. ఓకే సార్. ఓకే సార్. ఓకే. అన్ని స్మాల్ లెటర్స్ కదా సార్? ఓకే సార్. ఓకే సార్. అలాగే సార్. థ్యాంక్ యూ సార్.
Balaji, sir. From now on, when you are in any other call, please go on mute.
Okay, sir. Okay. Thank you.
Sir, now I am assigning co-host credentials, sir. Kindly please check it, sir, from your end. Sir Srikanth.
Yeah, I got
Good
you.
morning, sir.
Morning. This screen sharing, you will have to enable it.
Yes, sir. Sir, Srikanth, sir, can you please check from your end?
Yes, it has come. It's fine.
Yeah, fine. And sir, Sudarshan, sir, the next remaining people who is going to act co-host, sir? Sir Sharvan, sir.
Sorry, sir. Sir, you can give it to Balaji, sir, because he will be doing the profile reading and all. So you can give it.
Okay. Now I'm making Dr. K. Balaji as a co-host.
Okay, sir. Okay.
Next, sir.
You can add me, sir, if that is possible.
Okay. So, Sarvan Krishna Swami.
Yes, sir.
Co-host, sir. Sir, I have done it, sir.
Okay. Thank you.
That's it, sir.
Yes, sir. Any other people can be added, sir? Possibility is there?
4, sir. Total 4. So far, I have given 3.
One more, you can add Karim, sir, as well. Karim, sir.
Karim, sir. Okay, sir.
Sheikh Karim, sir. Dr. Sheikh Karim.
Yeah.
Sir, మన మెయిన్ సార్ కి రాలేదు సార్.
ఎవరు? సుదర్శన్ సార్.
సుదర్శన్ సార్. మీరు బాలాజీ సార్ మెయిన్ 4 members.
Correct. Sir, Sudarshan sir, very important. Sorry.
Yeah,
you can remove Sheikh Karim, sir, and give it to Sudarshan, sir.
Let me check, sir. It is possible, is there?
If it is possible, you can add Karim, sir, also. Otherwise.
Yeah, I have done it, sir. No problem.
Okay. Thank you. Good night, sir. Good morning, sir.
Balaji. Hello. Balaji.
Sir, good morning. Sir, good morning, sir.
Good morning, Balaji.
Sir.
Participants ki. Mana speaker వచ్చారా?
Sir, join అయ్యారు సార్.
Speaker sir వచ్చారా?
జాయిన్ అయ్యారు సార్.
ఓకే. నువ్వు లింక్ పెట్టేసి వాళ్ళు జాయిన్ అయిపోతారు.
ఓకే సార్, ఐ విల్ ఫార్వర్డ్ సార్.
ఓకే.
ఇంకా టైం ఉందమ్మా, కరెక్ట్ గా 10 కి స్టార్ట్ చేయండి.
స్టార్ట్ చేయడం 10 కి చేద్దాం సార్.
అదే
పార్టిసిపెంట్స్ అందరూ వస్తారు.
ఓకే.
సార్ నౌ
శ్రీకాంత్ కౌండిన్య సార్ గుడ్ మార్నింగ్. శ్రీకాంత్ కౌండిన్య సార్ గుడ్ మార్నింగ్.
Good morning.
Good morning, sir. We are very lucky, sir. Today we are enjoying again your lecture. We are very lucky today.
No, I'm equally lucky.
Not only myself, all participants are also going to enjoy.
I hope so.
From different countries.
Yep. I saw that too. Yeah. Okay. No, I feel equally honored to be here for the session.
Okay. Yes, you directly came to Tirupati through Zoom app.
Yeah.
Hello, Srikanth sir. Good
Hello,
morning.
sir. Morning.
Hello,
Good
Director.
Welcome, welcome.
Okay.
Sarvanan, tell me. What? Mute. Already muted. Sorry, unmuted. Unmuted already. Okay.
So, Sudarshan sir, so those who are joining as a participant, they will be in mute only, sir. I have done that, the credentials. Only co-host having the credentials, they can mute and unmute it, sir. And remaining people, they will be muted only, sir.
Manishankar, good morning.
Okay, sir. Okay, got it.
Good morning, sir.
Unshankar garu, good morning.
Good morning, sir.
Good morning.
Manishankar మాతో ఉంటే రథసారథి ఉన్నట్లే.
So far 46 is there, sir.
In Mahabharata war, sir, Srikanth sir, in Mahabharata war, Lord Krishna is our Munishankar. And a team effectively running.
Good morning, sir.
Morning. Morning.
Manishankar sir.
యూట్యూబ్ లింక్ ఎంతమంది వచ్చారమ్మా? యూట్యూబ్ స్ట్రీమ్ లో ఎంతమంది ఉన్నారు?
At the moment 13, sir. At the moment 13 are watching.
Okay.
14. Okay, 13.
Manishankar sir.
Ravanan, please take all precautions with regard to this e-certificate generation.
Yes, sir.
Both Zoom platform and YouTube streamlining. So in that stream also, how many participants are coming? Please take utmost precautions such that will not be in a troublesome at the end.
Sure, sir.
Thank you.
Yes.
Sir, I forwarded details in group, sir.
Okay.
Thank you, sir.
Good morning, sir.
చెప్పండి.
All team members, after listening your class with regarding the team spirit, everybody became team spirited persons.
Thank you. Thank you. That's why I call 24 gems.
24 gems is a very good word, sir.
Thank you, sir. Thank you, sir.
You have 24 brothers and sisters, sir.
Thank you. Thank you.
Your family is a very large family.
Thank you. Sudarshan, shall we commence exactly by 10 o'clock or shall we give a leverage of 2-3 minutes extra? Because it is 90, almost Zoom platform, it is full.
Yes, sir.
So YouTube link, I think I need feedback from Munishankar, please.
At the moment in YouTube, it is 31, sir.
31.
34 now.
34.
Yes.
We will start exactly at 10 o'clock, sir.
Right, we'll proceed.
Okay,
Okay.
sir.
Okay.
We will follow the punctuality.
Right now. Right.
Our chairman
We'll go ahead. We'll go ahead. No problem.
Okay. Our chairman is a punctual man. We also follow.
Okay. Correct.
We'll start, Ma. Please proceed.
Sir. Thank you, sir. Am I audible?
Yes, you are audible.
Yes. Okay. On behalf of our Honorable Chairman, Dr. Manchu Mohan Babu Garu, revered young and dynamic Chief Operating Officer, Manchu Vishnu Garu, respected advisor and Director, Professor L. Venugopal Reddy Garu, officials of Sri Vidyaniketan Educational Trust, our beloved Director of Sri Vidyaniketan Institute of Management, Professor N. Gurunatha Naidu Garu, I am privileged to extend a warm welcome to today's resource person and keynote speaker, Shrikant Kaundinya Garu, Assistant Vice President, MCX, Mumbai.
Thank you.
Distinguished academic colleagues, dear participant, friends, and other invitees, very good morning, and I extend a warm welcome to you all for this wonderful one-day webinar on commodity derivatives market, a complete approach. I am Professor D. Sudarshan Murthy, Sri Vidyaniketan Institute of Management, Tirupati. Indian markets have recently thrown open a new avenue for retail investors and traders to participate in commodity derivatives. For those who want to diversify their portfolios beyond shares, bonds, and real estate, commodities are the best option. Commodities actually offer immense potential to become a separate asset classification for market savvy investors, arbitrators, and speculators. Commodities are easy to understand as far as fundamentals of demand and supply are concerned. Retail investors should understand the risk and advantages of trading in commodity futures before taking a leap. Historically, pricing in commodities futures as less volatile compared with the equity and bonds, thus providing an efficient portfolio diversification option. Like any other market, the one for commodity futures plays a valuable role in information pooling and risk sharing. The market mediates between buyers and sellers of commodities and facilitates decisions related to storage and consumption of commodities. Full stop. In the process, the underlying market more liquid. There are many benefits with the commodity derivatives, such as price risk management, price discovery, commodities as an asset class for diversification of portfolio risk. Commodity derivatives markets are extremely transparent, high financial leverage, an option for high net worth investors, useful to the producer, useful for consumers, useful to exporters, benefit to corporate entities. Though there are many benefits, besides that, some challenges are also there before the commodities market, such as legal challenges, regulatory
Not audible.
invest all these into consideration. I am fortunate to organize this one-day webinar. We are privileged to have an eminent speaker like Shrikant Kaundinya Garu. Sir will be discussing all the aspects which include creating awareness of commodity derivatives market, various investment opportunities, trading process, futures and options, and hedging with the futures, etc. I hope this platform shall be useful to all participants to understand all these things. Thank you for giving this opportunity. Over to our beloved director, Gurnath Naik sir.
Thank you, Dr. Sudarshan. Am I audible?
Yes, sir. You are audible, sir.
Yes. Warm welcome to all my dear participants, faculty members of SWIM. Today's webinar resource person, Shrikant Kaundinya Garu, Assistant Vice President of MCX Mumbai. I congratulate webinar coordinator, Professor D. Sudarshan Murthy Garu, co-coordinators Sri K. Sharavanan and Dr. K. Balaji, Assistant Professors of SWIM, for choosing a nice topic for today's national webinar on commodity derivatives, a complete approach with a right resource person. Sri Vidyaniketan Institute of Management has been established in the year 2007 by Sri Vidyaniketan Educational Trust, headed by Padma Shri awardee Dr. M. Mohan Babu Garu and young dynamic film actor and also our CEO Manchu Vishnu Garu, with an intention to bring management studies for the convenience of all people, with the vision of training students to be the best in their chosen fields of management. SWIM offers 2 levels of postgraduate programs, including Master of Business Administration and Master of Computer Applications. All programs of SWIM are AICTE approved. We are affiliated to Sri Venkateswara University, Tirupati. With a talent pool of faculty, interactive pedagogical approaches, continuous mentoring, training in life skills, and also placements in multinational companies with state-of-the-art infrastructure, Sri Vidyaniketan Institute of Management is all set to transform students as competent professionals. In a nutshell, we not just impart the life skills in SWIM, but also help students gain a skilled life to succeed. And today's derivative markets Derivative market is a financial market for derivatives, financial instruments like futures contract or options which are derived from other forms of assets. Commodities are raw materials that are sold in bulk such as oil, wheat, silver, gold, oranges, cocoa, etc. Eventually, these are used to produce goods such as gasoline, cocoa for chocolate, wheat for bread. The history of organized commodity markets in India goes back to 19th century. Commodities markets will have three broad categories of market participants apart from brokers and the exchange administration. They are hedgers, speculators, and arbitrators. There are four commodity exchanges in India. The first one is multi-commodity exchange called MCX, India's first listed exchange with state of art at Mumbai. Fortunately, today's resource person is Assistant Vice President of MCX, is with us to enrich. The second one is National Commodity and Derivatives Exchange Limited, called as NCDEX, located at Mumbai. The third one is National Board of Trade, called as NBOT, located at Indore. The fourth one, National Multi-Commodity Exchange, that is NMCE, located at Ahmedabad. In these exchanges, different types of commodities are traded. They are under precious metals, gold, silver, and platinum, and other metals, nickel, aluminum, copper, etc.
Okay.
Agro-based products such as wheat, corn, cotton, oils, oil seeds, then coffee, soft commodities such as coffee, cocoa, and sugar. Livestock, under that, live cattle, pork bellies, etc. Under energy, crude oil, natural gas, and gasoline. With main participants in commodity markets are hedgers, speculators, and arbitrators. Let us now join to listen to Srikanth Kaundinegaru, who is an eminent and a person with a lot of experience, is going to enrich us on commodity derivatives market. Thank you, one and all. Over to Srikanth Kaundinegaru. Thank you once again.
Sir, sorry, sir. Now I will read the profile of our speaker.
Oh, yes.
Okay.
Balaji, Dr. Balaji.
Yes, sir. Yes, sir.
Okay.
Yes, sir.
You can read. You can
carry on.
Okay.
Warm and happy morning to our honorable speaker, Mr. Srikanth Kaundinya, sir, and our honorable director, Professor N. Gunadhan Naidu, sir, and all my colleagues of SWIM and the valuable participants. Welcome you all to today's webinar on commodity derivative market, a complete approach. It gives me the immense pleasure to share the profile of today's honorable speaker, Mr. Srikanth Kaundinya, sir, FCMA, Fellow Cost and Management Accountant, CGMA, Chartered Global Management Accountant. Sir is currently working as Assistant Vice President for Multi-Commodity Exchange, MCX, Mumbai. Our speaker is versatile personality and fellow member of Chartered Institute of Management Accountants and has 25 years of diverse experience in finance and capital markets, especially in the areas such as audit, research, ERP, MIS, and corporate training. Sir has very good insights into operations in organized exchange, trade markets. He has been involved in imparting knowledge to regulators in India and abroad in the past and has taken up several assignments with world agencies. Our speaker worked abroad in countries like Africa and UK. Sir has experience for more than a decade in commodity space. Sir is currently leading training and education function at Multi-Commodity Exchange, MCX, Mumbai. We are very fortunate to have you as a resource person for today's program, sir. Thank you, sir.
Thank you.
Now, I will hand over the session to our honorable speaker to give his valuable inputs to our participants. Thank you, sir.
Thank you. Thank you.
Srikanth sir, I extend a warm welcome to you and share your knowledge to all participants and to us also. You have blessed me, sir.
Right. The pleasure is all mine to be here in this morning. I hope that you can hear me clearly. Before I start, I just want to say that we have had very heavy rainfall right now is going on in Mumbai. So if there is any problem with connectivity, you don't worry, don't log off. I will get on it again. But I hope now we don't have a problem. Now,
definitely,
I was very surprised and also very happy to know that there are so many people, so many participants on today's webinar. And the topic, of course, is a complete approach. And I understand that we may have participants who have a bit of knowledge, some may have more knowledge, some may have no knowledge at all. And hence, I have designed this particular session in such a way that everyone will get something out of this. Now, very beautifully designed this session, these sessions, there are two sessions, one now and one in the afternoon. So the second half will be more on options. But today, this particular session is going to be on futures, and a lot of it is going to be on getting the hang of a commodity markets. So with that, I'll get started. The way I have decided to go ahead with this particular section is I want to bring in some basics knowledge into everyone's mind and it builds up the background for the commodity markets. So first question is, how familiar are you with commodities? Now here, I just want to tell you that whenever you go and buy something from a shop, you must understand that someone is keeping a tab on what you're buying, because that final product that you're buying will require a raw material to manufacture that product that you're buying. In other words, whatever you buy from a shop or you order online these days, it always involves a raw material. Okay. So when I say how familiar are you, you are definitely very, very familiar. I always say that in the morning, if you have had breakfast, if you have had something fried, then there is a oil there. If you have had some chutney, it has got another commodity which has come in, like mentha, with like what we call pudina. If you have traveled today, then you have used a vehicle which has got rubber tires. Rubber is again a commodity. It has had fuel. It could be energy from point of view of natural gas, or it could be petrol or diesel. But these are all commodities that you're accustomed to it and you're using it all the time. So when I say how familiar are you, I noticed that there are some ladies as well today, and if they're wearing any ornaments, there's a bullion segment behind them that is gold and silver, platinum, palladium. So you just have to think of your daily lives and you'll find that you're connected with commodity. Now, major commodities, what are they priced in? Now, this is important. You will be very surprised to note that majority of the commodities in the world are priced in US dollars. And it is extremely important for you to know that. So in fact, commodities which are traded on exchanges in India, almost 85% of them are priced in US dollars. Even if you're buying cotton, and India is the largest producer of cotton, sometimes we are number one, sometimes we are number two. There is a tug of war who is going to be number one in production of cotton between India and China. But the point of the matter is that cotton is priced in US dollars. And crude oil, gold, silver, whatever you can think of, majority of the commodities are priced in US dollars. Now, why I'm talking about this particular point and why I've brought it up as point number 2 here in the introduction is because I want you to always remember that we in India, we are takers of price. We are not the setters of price. We are the ones who accept the price which is coming from elsewhere. And the third one is how are commodity prices arrived at? Now, this is a very easy question to answer because it is basically demand and supply. There's nothing more. Whenever you look at prices of commodities, it is all about demand and supply. Even when you're buying a derivative contract, which I'll talk about in a few minutes, the price which is set for that particular contract when people are buying or selling those contracts is all dependent on how many buyers are there and how many sellers are there for that particular contract. Now, when you talk about categorizing commodities, yeah, it's easy because there are so many commodities, right? That it becomes a little bit of an issue as to how do I explain to someone what commodities are. So we put them into silos. Yeah, we basically put them into 4 silos. The first one, I call it the bullion segment. Yeah, in which we have precious metals like gold and silver and platinum and palladium. In India, on the commodity exchanges, we only trade in gold and silver. Platinum and palladium, we do not have any contracts on them, but they can be traded elsewhere in the world. Now, that is the first segment. The second segment is base metal. The base metal are basically non-ferrous, which means no iron in it. So that is your zinc, lead, tin, copper, nickel. Yeah, these are your commodities, which are base metals, extremely useful for construction and very important for industry. In fact, the World Bank also looks at the consumption of base metals in various countries to find out if any developmental activity is going to take place or is happening in that country. So based on the consumption pattern of base metals, a lot of information comes out. The next segment that I want to talk about is the energy segment. Now, in the energy segment, we have electricity, crude oil, natural gas, coal. But in India, on exchanges, we only have natural gas and crude oil. So this is the energy segment, the third segment that I'm talking about. The fourth segment is the agriculture segment. Now, agriculture segment, again, there are so many commodities, but we can also, of course, bring them into some sort of some semblance of order. So what we say about commodity segment, agri segment, we break them into plantation crops like natural rubber, coffee, crude palm oil. These are plantation crops. We have oil seed. Now, oil seeds are all those commodities, all those, pouches of oil that you buy from your grocery shop. Yeah, those oil, like you can have groundnut oil, you can have crude palm oil, you can have a sunflower oil, you have mentha, or you can have soya oil and cotton seed oil. So there are different oil seeds. So that is one more sub-segment within the agri commodity. In addition to that, we also have something called spices. And the locality where you are in the south, that is very, very, very famous for spices, which is again a very important component of the agri sub-segment, agri segment of the commodity markets. So these are your different commodities which are there. So categorize them. So whenever we look at a commodity, we need to understand where they fit in. And almost everybody, or almost all commodities fit into these segments. There's one more thing that I want to get into before I get to the next slide, which is we must understand that there are 2 markets. One is a spot market and the other one is a derivative market. I'm going to explain more on this, but I want you in the back of your mind to be very clear that there are 2 markets. Spot market is when I go into a shop, pay money and buy the goods. I can go to a supplier of a raw material, pay money and buy the goods. That is a spot trade, as we call it. And on the other side, I have something called a derivative market, a derivative trade. I'll explain more on that. But at this stage, I want you to be very clear. There are 2 markets, spot market and derivative market. Both these markets, they are running parallelly. That means they both move simultaneously. They're moving together. There's one more point here, that is your timings for trading. Now, when you talk about timing for trading, the timing I'm talking about here is the timing of trading on the exchange. on an exchange, we start trading at 9 a.m. in the morning and we trade until 11:55 p.m. And sometimes we also trade until 11:30 p.m. Now that difference is because of time changes and because of because we are taking pricing from international markets, and hence we keep trading till that late hour. So unlike stock markets, which stops trading at 3:30 in the afternoon, commodity markets trade until 11:55 p.m. Now, one of the reasons why this is so is because the price discovery is happening in international markets. Yeah, so when you have price discovery happening in international markets, we want to give a chance to people who are trading to adjust their positions to whatever is happening in the international markets, because the price might have changed because of demand and supply in international markets, and hence we want to give that particular chance to trading community in India. So if any change happens abroad, people in India can adjust their positions based on the changes, based on price changes that have happened in international markets. That is mainly because 85% of commodities, like I said, are priced in US dollars. This particular slide now, we call it the financial markets, because we are now in the financial markets, that little red commodity markets, that is what we call asset class. So we have these different asset classes: capital markets, debt, currency, commodity, money markets. These are all asset classes. Now, why it is important that we understand these asset classes is because they are all interrelated. And like I said, commodity markets are affected by many things in the other markets. So let me just break it down. Let me start with the debt market. When I talk about the debt market, what am I talking about? I'm talking about the underlying which moves the debt market. So what moves the debt market? The debt market is moved by changes in interest rates. Now, you must have heard that interest rates are very often changed by governments. Yeah, actually, it is not the government which changes the interest rates. Interest rates are changed by the central banks of countries. Yeah, as part of their monetary policy. Now, when interest rates change, it does something. What it does is that it has an impact on currency. That means whenever you find interest rates changing, it will have an impact on currency. Currency will become stronger or weaker because of changes in interest rates. Now, here we must be very careful that I am here mainly focused on interest rate changes in America and interest rate changes in India. Why? Because we are more concerned about the rupee dollar currency exchange rate. Now, if there is a change in US interest rates in America, it will have an impact on rupee dollar. If there is a change brought in by the RBI in India on the interest rates, it will have an impact again on the exchange rate. That particular relationship is what we call an inverse relationship. It's called a direct relationship, which means in America, if the interest rates were to come down, then the dollar becomes weak. If the interest rates in America were to go up, then the dollar becomes strong. Now, what do you mean by strong dollar and a weak dollar? It just means if a dollar is strong, you need to pay more rupees to buy the dollar. Now, the second connection is between currency and commodity. Now, if interest rates change, it has an impact on currency. If there's a change in the exchange rate, it has an impact on commodity prices. And hence, if you're trading in commodity markets, you must have one eye on what is happening to the exchange rate. Capital markets, how does this fit in? Capital markets fits in because sometimes people think that India is a very good destination for investment in the stock market. A lot of money comes into the country. Sometimes there's news that India is not such a nice place. So people sell their stocks and they move out of the Indian economy. But whenever this movement takes place, what it does is that money, this movement of money has an impact on the rupee dollar exchange rate. So nothing to do with commodity. Just because people think India is a good destination for investment, or some people think India is not a good place, not a good destination for investment, money coming in, money coming out. This is in millions of dollars or crores of rupees worth of money coming in and going out. And when that happens, it shakes the exchange rate. And when it shakes the exchange rate, it has an impact on commodity prices. So I want you to understand that when you find commodity prices changing, there are many factors which have an impact on that price. So let me go ahead. So during this current pandemic, so have you noticed interest rates changes? So I'm sure you have. In America, they've cut interest rates. In India, we have too. Why did we cut interest rates? Interest rates have been cut because it is part of the policy, monetary policy, to stimulate the economy. So you want to stimulate the economy by making money cheap so that people borrow money and activate the industry. But what it does is it has an impact on prices of commodities. So how about exchange rate changes? Have you seen it? Have you heard of exchange rate changes? Of course, like I've already explained to you, when interest rates change, it has an impact, a direct impact on exchange rates. And how about India's Forex Reserves? So have you kept an eye on the Forex Reserves? Now, you'll be surprised to know that India's Forex Reserve, as of yesterday, that I last checked, was 538 billion rupees. Yeah, sorry, 538 billion dollars. That is the reserve that we have with the RBI. Now, one of the reasons why this reserve is going up, we are not importing crude oil. Why are we not importing crude oil? We are not importing it because of the pandemic. Nobody's driving around so much like they did before. And hence, one of the biggest import component for us was crude oil, which is a commodity. And hence, that is also having an impact. The other thing is, how many of us are going to the shops to buy the bullion, gold or silver? Not many of us are buying it. Shops are also closed in many parts of the country, and many people are worried as to how the pandemic is going to pan out, and hence people are not buying that much gold or silver in the physical segment, which means that government is also not importing much, and hence you have seen the impact on the reserves of the country. Yeah, and this all because of the pandemic, and it all has an impact. The minute the reserves go up, it strengthens the rupee. If it strengthens the rupee, it has an impact on commodity prices. The other one is supply and demand for products. Now, we are not buying enough in the markets because everything is under lockdown. It's not just us. It's 162 countries under lockdown. People are not buying, and hence there's a demand destruction which has taken place. And similarly, if these people are not buying, the producers, the manufacturers are also thinking twice about producing something. And hence, when you talk about supply and demand for products, I think because of the pandemic, you must have realized that there is not much activity when from the point of view of manufacturing, and from the consumer's point of view, people are not buying. But what that does is it has an impact on the GDP. And what is GDP? The gross domestic product of countries. And you must have seen this happening around the world if you have been watching television, because I think that's what most of us probably do these days, and we should. And if we are all finance students or commerce students, then we should be watching the finance channels. And in fact, in Bombay, in some of the areas where I live, for example, we don't even have newspapers right now. But the point of the matter here is that GDP has come down, yeah, because there is no supply, no demand, not much production happening. But we're going to come out of it. You don't have to worry on that. This particular slide is a very old slide, but I just brought in to hammer home the point that I've made. What is basically saying that if you can see these red lines are basically commodity prices. And what commodity prices? This is basically, there is something called a commodity index of 19 commodities. Just like you have a Nifty in the stock market of 50 stocks. Like that, you have a S&P commodity index of 19 commodities. And the other line there, the blue line, is basically showing you the strength of the US dollar, the USD index. And you can see very clearly that whenever the dollar is strong, the commodity prices are weak. When the dollar is weak, the commodity prices are very high. Yeah, it's very logical. Is basically saying that if I have to sell you a commodity, and in return, if I'm getting a currency called dollar, and if that dollar is not allowing me to buy lots of stuff, then I will demand more for it. Yeah, because If I'm selling you a commodity and you're giving me $50 for it, then the $50, if the purchasing power of the dollar is weak, then I will demand $55. So what we call the dollar and commodities have an inverse correlation. Strong dollar, weak prices of commodities. Weak dollar, strong prices of commodities. Okay, now when you come out talking about commodities, when we talk about MCX and we're talking about commodity markets, we are basically talking about raw materials. Yeah, raw materials used to create a livable world. Like right at the beginning, I said that what exactly, how comfortable are you with commodities? How much do you know about commodities? It's just that to create a livable world, manufacturers need raw materials to produce the final goods that you will go into the shops to buy. Yeah, and they are basically inputs. When we're talking about commodities, they are inputs in the production of other goods. So even if you invest money in the stock market, how well the stock market does will depend on how efficiently it will procure the raw material, and hence the inputs in the production of other goods, yeah, commodities, also has a bearing on how well some of the stocks in the stock market, how some of the scripts or how some of the companies which are listed on the stock markets, how well they perform is also dependent on how efficiently and effectively they're able to procure the raw material to produce the final goods which they will sell in the market. Okay, now one thing you must understand that on a commodity markets, on MCX, for example, we are buying a derivative, and I'm going to explain derivative in a few minutes. But one thing you must understand is that I'm buying something in the future. That is what a derivative is. A derivative allows you to buy something in the future. Now, if it is allowing me to buy something in the future, what does it tell me? It just tells me that it also allows me to sell something in the future. Yeah. Now we'll explain that much more as we go ahead. But at this moment, I want you to understand that if I am buying something in the future, or if I'm selling something in the future, then I have to price it. I need to know what I'm buying. Unless I know what exactly I'm buying, I will not be able to price it. And hence, whenever we buy something or sell something in the future, it has to be something which is homogeneous, or it is standardized quality. Now, if I ask you, how much are you willing to pay for gold in the month of December? Yeah. So basically, I'm saying that if you want to buy gold in December, and can you tell me now how much you think you would be willing to pay for it? Now, the first question that you should be asking me is what quality? Is it a 99% pure gold? Is it a 70% pure gold, or something other kind of a mixture? And hence, whenever you are talking about buying or selling a contract in the future, it has to be something which has got no qualitative differences. It has to be a standardized contract. And that is what is offered on an MCX platform, on any futures exchange platform. Whenever you're buying something, it has to be of a standardized quality, because only if it is of standardized quality, you will be able to price it. The other one is we break up commodities into hard and soft commodities. Soft commodities being anything that you grow, like agriculture commodities are soft commodities, and anything that you mine is called a hard commodity. And we also have intangibles like freight, weather, and electricity. Now, these are commodities, we call them intangibles, but there's a lot of trading going on. In India, we have electricity, but there is a separate exchange for electricity at the moment. But once we have a derivative in electricity, I'm sure these contracts will also be launched on the MCX. Internationally, the people who are buying freight and weather futures, but these are intangibles where we don't have them in India. But I'm sure at some point in time, we will eventually see contracts in freight and weather in India as well, because there is a very strong policy decision making, which is suggesting that we have to make our country at par with the Western countries when it comes to the financial markets. And if they have freight and weather, trading in freight and weather, I'm sure we too will have that in due course. Now, this is an extremely important slide of mine. Many of you might have seen it, but I want you to concentrate on this particular slide, because at the end of this slide, if you've understood whatever I'm going to say now, it will make life easy to understand the commodity markets. First, what is traded on a commodity exchange? Now, many of you might say, what a silly question, because commodities are traded on commodity exchanges. But the answer is no. We do not trade commodities on commodity exchange. What we trade is commodity contracts. So I'm trading contracts on commodity exchange. So MCX, for example, we have contracts which are trading on the exchange. What exactly is a contract? The contract is the product of the exchange. Just like you have a car, like you may have a Maruti, a car, a product of the Maruti, car maker, automakers, like that is the product. Similarly, the product of an exchange is a contract. What exactly is a contract? It's just like a 3-page, a lot of information on it. Yeah. And that is a contract. And we'll talk a lot of it later on. We'll talk on that as well. But I want you to be very clear here that what is traded on a commodity exchange is commodity contracts. What type of contracts are we trading? We trade futures and options contracts. And like I said, we're going to talk about options in the afternoon today in detail. But right now, I want you to understand what really is futures and options. So what are futures and options? Now, futures and options, in one single word, we call them derivative. Yeah, so futures and options are derivatives. Now, what really are derivatives? Now, derivatives are financial instruments. So what are they? They're financial instruments. Now, these financial instruments, they have 3 characteristics. So in other words, all your your financial instruments. Well, let me step back a little. Derivatives are financial instruments. What are financial instruments? We can break financial instruments into 2 categories. We say spot financial instrument and derivative financial instruments. So there are 2 categories of financial instruments. When we talk about the cash financial instruments, examples would be cash in your pocket, your checks, your demand draft, loans, bills of payment, your promissory notes, your any mortgages you take, or any shares that you buy. So these are known as cash financial instruments. They are called cash instruments because the value is known. So 100 rupee note says 100 rupees. So you know the value. It is very apparent right at the outset. These are cash instruments. On the other side, I have a derivative instrument. And what is traded on a commodity exchange are derivative instruments. Examples, futures, options. Yeah, they're traded on exchanges. But there are other derivative instruments too, like forwards and swaps. So these are all the 4 major derivative instruments which are available. So what is special about derivative instruments? Derivative instruments have got 3 characteristics. The first is that it is a value in the future decided by me now. So let me elaborate. If I'm buying gold at a price of 45,000 in the market today at a jeweler's shop, if it's going to cost me 45,000, then I'm going to ask you now, how much are you willing to buy gold for in the month of December? And we are right now in the month of August. Now, a derivative instrument allows you to buy or sell in the future, in the month of December, today, at a price that you think is going to be the price. That is the first characteristic of a derivative instrument. It allows you to buy or sell in the future now. The second characteristic of a derivative instrument is that when you buy or sell this instrument, it involves a very small amount of money. Now, when I say small amount of money, it could be 2%, 5%, or 10% of the total value. So why does it have to be such a small value? The reason is if I have to pay the entire amount of money, then I might as well go to the spot market and buy the commodity right away. But if I'm buying something in the future, then I'm going to get the delivery in the future. If I'm selling in the future, I'm going to get my money in the future. And hence at this stage, I will only pay a small amount of money. Now, this small amount of money many times is part of risk management. In the futures market, the small amount of money is called margin money. It is there to ensure that the people who have bought and sold the contract in the future are connected with the contract, and hence they pay a small amount of 5% of the total value, which is actually doesn't leave their account. It is lies in their account and it is blocked in their account. And if they wind up they square up their position, that money is returned to them. Yeah, not in options. Options behaves differently, but the small amount of money involved when you're buying a derivative. In a futures market, the small amount of money is called margin. In options market, the small amount of money is called a premium. In swaps and forwards, the small amount of money is often called commission. Okay, and hence the second characteristic of a derivative is that it involves a small amount of money. The third and final characteristic of a derivative instrument is that that instrument comes to an end on a contract date, which is always in the future. So we have a contract date. It would be something like, let's say, 31st of December. Now, that is not a contract date. A contract date has to be more specific. It will be like 11:55 p.m., 31st of December. Now we are talking. So now I know when the contract is going to end. Yeah, on a particular date and a particular time in the future. And on that date and on that time, what happens is the contract will expire and it will be settled. It can be settled in cash, or it will be settled by give and take of the raw material which was originally purchased. Now, this is the three characteristics of a derivative. Now, these derivatives which are there on MCX, why are we call them contracts? We call them derivative contracts or commodity contracts. Now, why do we require these contracts? Now, the exchanges have been set up so that people can trade in these contracts. Yeah. Now, why has the government allowed exchanges to come up so that people can trade in the contracts? Why? Is it that the government wants people to be speculators? They want people to just gamble away? Is that the reason? No, it is not. The reason why commodity exchanges are there and why we have these contracts is for two purposes. The first one is price discovery and other one is managing risk. Now, what exactly is price discovery? Price discovery actually means that the market, the buyers and sellers, they get together, and when they're trading, the last trade that comes out is considered to be the discovered price. So price discovery happens when you have many buyers and many sellers. So when you have many buyers and many sellers, the trade that comes out of such kind of a market is considered to be a discovered price. So there's price discovery that is taking place. The other thing is, the other point here is managing risk. That is why the commodity exchanges are there. So what exactly do we mean by managing risk? It means risk caused because of price volatility. When prices keep going up and down, that is called volatility. When prices are moving up and down, it causes a lot of problems for the consumers of commodities and also for the sellers of commodities. And that is the risk that they have. This is called price risk. And one of the reasons why commodity exchanges are there is so that people can manage that price risk. So when you're talking about manage risk and price discovery, these last two, these are many times known as the pillars of the commodity exchange. The commodity exchanges are there to give an opportunity to users of commodity to manage risk. And of course, the other beautiful part of that is price discovery. That is, we come to know what the price is. Now, this map of the world, so many exchanges. There are 86 exchanges worldwide. In India, we have 5 exchanges for commodities. BSE, NSE has also come on board for commodity exchanges. Yeah, they are also setting up commodity exchanges. So in India, we have 5 exchanges, and you can see so many exchanges in the world. Now, why am I talking about these exchanges? Because price discovery is taking place everywhere in the world. It depends on the commodity. For example, if you see this one, it says LME, London Metal Exchange. That is where the prices of base metals, that is what we call non-ferrous, lead, zinc, tin, aluminium, copper. The prices are discovered on the LME. Why are prices discovered on LME? Because LME has something special. What does it have special? it has many buyers and many sellers. And because of many buyers and many sellers, what do you get? You get price discovery. And that price is in dollars, and we convert it into rupees, and the trading begins in India. Similarly, if I have to look at bullion, which is gold or silver, I'm looking at the CME, the Chicago Mercantile Exchange. Why Chicago Mercantile Exchange? Because the maximum trade in bullion happens on CME, Chicago Mercantile Exchange. We also have ICE Exchange. What is ICE? Intercontinental Exchange. What is the speciality of ICE Exchange? That is where the price of cotton is discovered. So cotton prices are discovered on the ICE Exchange. How about LIFE, LIFFE, or LIFE, some people call it, but it's LIFE. On this exchange, the prices of many commodities are discovered, but it is more popular for the discovery of the price of coffee. Yeah. And similarly, we have exchanges everywhere. TOCOM. TOCOM is where we discover the price of oil, yeah, or also of jet fuel. So that is where we look at that. The Chinese exchanges are very popular for the price discovery of soya cakes, soya beans, soya. Yeah. I mean, you can't eat Chinese without soya sauce, and hence anything to do with soya, prices have been getting discovered there in the Chinese exchanges. Okay. But the point of the matter, I'm basically like this particular slide is because I like to tell everybody that while you're sitting at home during the pandemic, one of the things that you can perhaps do is that all these exchanges have got one thing in common. They all have websites. So all you need to do is use your time carefully, use it effectively, go and check out the websites of various exchanges in the world. Okay? And you will find a lot of information which will make you wiser. Okay. Now, when you're talking about the commodity exchange traded commodity markets, first thing I want to tell you is there's something called entry and exit. Yeah. So during the market hours, right from 9 a.m. to 11:55 a.m., like 11:55 p.m., I can enter and exit the market, right? That means I can buy a contract or I can sell a contract. Now here, I don't need to own any commodity to sell a contract. That means I can sell a gold contract even though I do not have any gold with me. I can sell a cotton contract even though I do not have any cotton with me. A farmer many a time sells a cotton contract against cotton which has yet to be harvested. Yeah, so he doesn't have the cotton, but he's able to sell it. In other words, you can enter and exit the market. And when you talk about enter and exit the market on a commodity exchange, what are you entering and what are you exiting? You're entering a contract and you're exiting a contract. And because you can do this at any time during the trading hours, we call this free entry and free exit. You can enter at will and you can exit at will. But the price at which you enter or exit, or the price difference between the time you exit and you enter, yeah. So when you're entering and exiting or entering and exiting and entering, we call this squaring up your position. So whenever you're doing that, the difference between the price at which you've entered and the price at which you've exited, the difference would decide whether you have made a profit on that contract or loss on that contract. But you can do that all the time. You can enter and exit. It's called free entry, free exit. The next part is standardized quality. When I'm buying these contracts, I need to price it. So when I'm pricing these commodities, I need to have a standardized quality, because if I don't have a standardized quality, I will not be able to price it. And you must have many buyers and many sellers. The exchange like MCX, we are allowing trade right from Kashmir to Kanyakumari. People are trading. Yeah, people can trade all the time, anytime. Yeah, from Kashmir to Kanyakumari, Bhuj in the east, Bhuj in the west, and Bhuj is a town in the state of Gujarat, is the westernmost town. And on the east, you have the Andaman Islands. You can trade anywhere. Yeah, and so because of that, because of trading going on through a laptop across the country, there are many buyers and many sellers. And because of many buyers and many sellers, what happens? We get price discovery. And there is perfect information. It's perfect information because everyone is looking at the same screen. So no one has additional information. Everyone is on the even page, on the same page. Everybody knows what price the last trade has taken place, what price, how many people are waiting to buy a contract, how many people are waiting to sell a contract. Everyone has this information, perfect information. Now, many of your students of commerce and economics or management. You have, I'm sure, at some point studied economics. So these 4 points that I put on the slide here, you must be familiar with them. You must have read them as part of the assumptions in perfect competition. Yeah, when you did your microeconomics perfect competition. These are the points that must have come across, you must have come across. And this is very relevant in industry, in our industry, in the commodity derivative segment. Free entry, free exit, standardized quality, many buyers, many sellers, perfect information. Okay. Now, when you talk about objectives of commodity exchange, I've already talked about risk management and price discovery. The other thing that we have is transactional efficiency. Now, transactional efficiency is because the bank, if the trader, the broker, the exchange, they are all linked electronically. And then hence there's a transactional efficiency. You can even trade through your mobile phone. And hence, because you're able to do that, the transactions are implemented very, very effectively and very efficiently. Yeah. And the other one is liquidity in the long run. Liquidity is long run because if I'm buying something in December, if I need some commodity like copper in the month of December, I can buy it now. Now, if I were to buy it in the spot market now, I would have had to buy it and keep it in the warehouse, and I would have had to experience, had to bear a lot of cost regarding the physical commodity, which I would now need to keep until December because I actually need it in the month of December. Now, I can avoid all that. I can avoid all that by buying a contract. And when the contract ends, I can demand delivery of that particular commodity. And hence, what have I had a lot of advantage here in the sense my money was still in my bank, only 5% approximately got stuck with the contract, and eventually it was paid back to me whenever I had squared up my position. Now, the other beauty of the commodity derivative market is trade guarantee, which means whenever someone buys a contract, then he waits for the contract to expire. At the time of expiry, if somebody wants the raw material in physical form, or if someone wants to give delivery, he wants to sell it in physical form, the exchange guarantees that trade. So that is the beauty of the derivative market. The exchange guarantees the physical exchange of money and goods at the end of the contract. And integration of asset classes, I already talked about that in the first slide. Now, commodity markets. Now, this is very important. I want you to pay attention here. We have two markets. One is a spot market and one is a derivative market. Both these markets exist in parallel. And then I'm talking about managing price risk, because that is what I'll be talking about from now on. Now, when you're talking about managing price risk, you must understand that what is really happening is I'm pitting one market against the other in such a manner that I do not make a loss. But remember, in hedging, I do not make a profit either. In other words, hedging is not a price making strategy. Hedging is a price mitigation strategy. It is about locking into the price in such a manner that I don't make a profit, but I definitely not make a loss. And hence, both these markets exist in parallel. And one more point that I need to understand, you need to understand here is something called an underlying. So whenever you buy a contract, you must always compare it with the underlying. So if I'm buying a potato derivative contract, then the spot price will be the price of potatoes in the spot market. If I'm buying crude oil in the derivative market, then the underlying is the crude oil in the spot market of the same quality. If I'm buying gold in the derivative market, then the underlying is the spot price of the gold. And hence I'm pitting both these spot prices and derivative prices and trying to lock into prices so that I do not make a loss. Now here, I want you to pay special attention here. Like I said, what exactly is a futures price? Because I have contracts on the exchange where I can buy a December contract, I can buy an October contract, a September contract, I can even buy a February 2021 contract. Yeah. So there's a future cost. So I need to price something in the future. So what is this future price or a future cost? If I'm buying something in December, how do I arrive at that future, the future price or the future cost? How do I arrive at that? If I'm sitting with a laptop today, how do I come to that? So I look at, it is done this particular way. For example, I want the price on the 5th of December. I'm looking for a price on 5th of December. what is the price of gold on the 5th of December? Can I ask you now? Now, to arrive at that 5th of December price, I need to know what the spot price today is. So I need to know what the price today is. To that price, I add a holding cost. What exactly is a holding cost? Holding cost means that if I were to buy the goods today and keep it till the 5th of December, what is the extra cost that I'm going to suffer? So it is going to be, by the way, holding cost is also called carry cost. So it is holding cost would be cost of money, because I'll have I would be buying in the spot market. If I were to buy today, then entire amount of my money would be locked up. That means I would be using up my money, all my money. So my bank account will show some money has left my account. So that's a cost of money. It will be the interest loss in that commodity that I've bought. Yeah, so that we call it interest loss locked into the inventory. If I buy that particular commodity in the spot market, then I need to have a warehousing cost, because I'll be keeping these goods in a warehouse and I may have to pay a rent. If it's a gold, then I would be putting it in a vault. There'll be insurance, there would be security. If it is an agriculture commodity, the warehouse cost will also include fumigation cost, yeah, to ensure that the quality of the goods do not suffer by the fact that it is in a warehouse. So I may do some fumigation, pest control. That is cost involved, and that all becomes part of holding cost. So if I'm trying to arrive at the future price, I know today's price. I know how many days are there between today and the 5th of December. I know what kind of costs I'm going to incur. And then comes the most important thing called a perception, plus or minus. It's called plus or minus perception. Remember, there's a plus or minus. Now, that perception is what the entire trading on MCX is all about. Because everybody knows today's price. Everybody knows the holding cost. Everyone can calculate the holding cost. Now, perception is what can happen by 5th of December. I'll give you an example now. What could happen from the point of view of the pandemic by the 5th of December? What will there be a vaccine by 5th of December? What will happen to the demand for the commodity by 5th of December? What could happen to the interest rates? What could happen to the exchange rate? And this is where the perception comes in. And this is the perception which makes the market exciting, makes the market very volatile, because everybody has a different perception of what could happen in the future. Why this minus? It could be, spot price could be of an agriculture commodity, and December might be the harvest season. And if it is a harvest season, I know that the price will be low on account of excess supply in the market due to the harvest season. And hence, this particular slide, you must remember very well. Please make note if you want to. Future price is spot price plus holding cost plus or minus perception. Perception is what the entire market is all about. Now, when you are buying in the futures, as I said, you only pay a small amount of money. That is the second characteristic of a derivative. But there are two things that happen. So let me tell you, there is one is a daily settlement and one is a final settlement. Final settlement is when the contract ends. For example, in the previous example, the contract ends on the 5th of December. Now, when the contract ends, two things could happen. People can settle by cash. That means if I've sold the contract, I buy back the contract. If I bought the contract, I sell the contract, I square up the contract, and the difference in the price at which I enter and exit is cash settlement. I can also do something called a settlement by delivery. That means at the end of the contract, I'll demand that I want delivery or I want to give delivery, and the exchange guarantees that delivery. But that always happens on the last day of the contract, and hence it is called final settlement. But every day that you are stuck with the contract, that you are entered the contract, every single day, there are two adjustments which are made. One is called the margin adjustment and one is called the mark to market adjustment. So let me go back again. So suppose beginning of this today, if I buy a 5th December contract, then every single day between today and the 5th of December, every single day, the margin adjustment will be made. Assuming the margin is 5% of the value, then every single day the value will change of the commodity, right? And it will change because the prices change, or it might change because I have bought an additional contract, but the value will be adjusted every single day. So if the 5% of the value has to be adjusted every single day, and it is managed very beautifully by the exchange in a very efficient manner by blocking and unblocking of the said amount in your bank account. So for example, if I bought something for 100 rupees yesterday and margin money was 5 rupees, 5%, so 5 rupees would get blocked. So suppose today the price had become 200 rupees, then 5% of 200 is 10 rupees. So by the end of today, an additional 5 rupees will be blocked. So that is 5% of the value blocked. Day after tomorrow, if suppose the price falls again, then and it becomes 100 rupees again, then 5% of 100 is 5 rupees. The additional 5 rupees which was blocked would be released. And hence, this margin adjustment takes place every single day. Similarly, mark to market is happening every day. If I buy something at 100 yesterday, to the price has become 200, I made a profit of 100. The 100 rupees comes into my account tomorrow morning. And if I had bought something for 100 yesterday and the price has come down to 50 rupees, I made a loss of 50. I will have to pay the exchange 50 rupees tomorrow morning. Yeah. And hence, this daily settlements are happening every single day. And is the beauty of this daily settlement is that the trader is on every day, he knows what his position is, what his risk taking ability is. And if he thinks he cannot take a risk, further risk, then he can square up his position and leave the market because we have free entry, free exit. So if he feels at any point in time that he doesn't want this contract, he can exit at will. Now, this I've already explained to you that we have commodities be broken into agri, base metal, energy, bullion. Now, demand and supply, we have seen what is happening during the pandemic. Yeah, in agriculture, just to give you an idea, cotton. How many of us have bought shirts or pants or anything cotton in the last 5 months? At least I have not, because I'm not able to go out. And even if I do go out, the shops are closed. Although they're saying that they are started to open. Of course, I can order online, but generally the consumption of the final product, which is manufactured using cotton, has come down drastically. Cardamom is used in the catering business, hotel business. How often are we eating out? We're not eating as much out as we used to. It's having an impact on the cardamom sector. Rubber, natural rubber, used in the manufacture of tire. India manufactures almost 5.5 million tires every year. But we're not driving around. Not many people are changing tires of cars. So you can imagine what has happened to the tire industry, what has happened to the natural rubber industry. Base metal, construction in many places have come to a standstill. Zinc, aluminium, copper are not being used as much as they were being used. Energy segment, crude oil, natural gas, same problem. Crude oil, we are not using as much as before. I already told you, our reserves have gone up to $538 billion reserves. One of the reasons being we're not importing much crude oil and we're not consuming crude oil. In fact, this particular, the photograph on the right-hand side, many of you might have seen it on it was doing its rounds on the WhatsApp groups. These little red dots are oil tankers sitting across the world where people are not buying and there's no place to store it. And hence we found all these little dots. These are all tankers full of crude oil. Now, natural gas, we use natural gas for making cement. It is used in the automobile industry for welding. Natural gas is also used in the glass sector, glass making, and we are seeing that is taking a hit. Bullion is the other way around. Bullion is gold and silver. We have seen prices go way up. The reason being, people are not very happy with the way the economies are moving right now because of the pandemic. And people think that, hey, where do I park my money? And a lot of people are buying gold and silver. But the point why I'm talking about this is that this is what is happening today in the spot market. Yeah. So similarly, some of these commodities are used for manufacturing. All commodity affects all commodity segments. And for example, I give you one more in the service industry, travel and tourism. It has impacted food because people are not traveling, people are not staying in hotels. It has affected airline industry. Many airlines have shut down. It has affected the aircraft manufacturing industry because they're not going to manufacture many aircrafts. Hotel industry, many hotels are suffering right now. I'm sure you know what I'm talking about. But the point of the matter is I'm talking about the spot market. And the spot market is affected by many things. The spot market is affected. And similarly, prices get affected. Prices are affected by prices ruling in the international markets, by currency, by geopolitics. It is affected by trade policy and regulations. We have seen governments all across the world bolstering their economies by push pumping money, like we have seen in the MSME segment. The government of India is trying to spend more money to help the small manufacturing industries. And this is what we mean by the fiscal policy of the government, where the government tries to push money to stimulate the economies. Then we have seen economic factors like recession. I think I've not talked about it. I'll talk about it in a minute. Inflation, that when you have a lot of money in the market, it'll have an impact on that. We'll see commodity specific events, statistical releases, you will see demand supply scenarios. So basically the point of the matter is there are many things which are affecting prices of commodities. And you can see the one in the red at the bottom, the COVID-19. And I've already explained to you what COVID-19 has done. But the point here is that if I am a user of commodity, and if I need a commodity in the future, I need a commodity to sell it, or I need the commodity to buy it in the future, I am going to be impacted. I'm going to be impacted by when the vaccine is going to come, for example. Yeah, I'll be affected by vaccines, when the vaccine is going to come. The minute the vaccine will come, it'll have an impact again on the commodity prices. Right now, commodity prices have fallen, except for the bullion segment. Yeah, all commodity prices are low, except for the bullion segment, because people are parking money in the bullion segment. Now, this particular slide basically talking about recession. And if you see, these little gray towers are recessions. What is basically saying is that when you come out of a recession, the price of commodities starts going up. So you can see here again, when you're in a recession, the prices of raw materials starts going down. When you come out of a recession, prices of raw materials starts going up. So you will see this happening again. The point here is, the worrying point here is for the users of commodities. I'm talking about the manufacturers or the suppliers of commodities. They need to understand that the price will change. So if you're seeing prices going down today, they'll start going up tomorrow. And hence, prices are always very volatile. You can see this volatility in prices. Yeah, prices are very volatile. They keep going up and down all the time. And two things come out of this. One, when you have prices going up and down, moving all the time, they're not moving in a straight line. Very, very volatile. Volatile markets give opportunities to speculators or day traders. Day traders try and make money in these little movements, these little ups and downs in prices. They give opportunities for the speculators or the investors to try and make money on these small movements. Okay. Whereas a hedger, he actually enters the market at whenever he wishes, and he stays with the commodity contract right up to the end. In other words, he only takes two positions. He enters and he exits. Whereas a speculator, he keeps going in and out all the time. The beauty of that is that whenever a hedger at any time decides that he wishes to enter the market, there has to be a speculator willing to take the risk. That is the importance of a speculator or an investor to the commodity market. So a speculator or a investor is always ready to take on the risk. So whenever a hedger enters the market, there's always be people on the opposite side willing to take the opposite position, because they too are going to make money. They are going to make money on the small movements. How about the hedger? Is he going to make money? Of course not. A hedger, his aim is to mitigate price risk. His aim is not to make money. He will make money on the final product that he makes eventually, but he's not trying to make money on the small movements of the price of the raw material. Now you can see this. It happens in the energy segment, in the crude oil. It is happening in natural gas. Very volatile. Prices are very volatile. And the volatility gives opportunities to speculators to make money, and volatility invites the hedgers to come and manage the risk. But that is why the markets are open to both. Now, just to give you again what I've been talking about, you can see this is the price. Prices are very volatile. The price keeps going up and down all the time. And you can see where I am today. So basically, when it says today, can you see where I'm saying today? So So this is today. Now I'm worried what will happen to the price. If I am a buyer of a raw material, I am frightened the price will go up. And if I'm a buyer of a raw material, I'm frightened the price will go up there. If I'm a seller of a raw material, I'm frightened the price will come down. And hence this triangle is risk. This represents risk. And this is the risk that can be mitigated using the contracts which are offered on derivative commodity exchanges. And that is the reason why these exchanges are there. These exchanges are there so that people can mitigate their risk. Okay, now what is hedging? Now hedging basically who is a hedger? So hedging is basically taking a position in the, you can read that future that is opposite to the position in the physical market. So who are hedgers? Hedgers are all these guys, corporate farmers and producers and intermediaries and merchandise. What is special about these hedgers? These hedgers are connected with the commodity. They are connected with the physical commodity. Whereas the investor, he is not interested in the physical commodity. The investor is only interested in the price movement, and he's trying to make money on the price movement. And the hedger is trying to lock into the contract in such a manner that he will not make a loss and he will not make a profit either. So he's basically trying to mitigate his price risk. And hence, when you're talking about hedging, it is about transfer of risk from the hedger to the investor. Investor who is trying to take the risk, and the hedger who is trying to mitigate that risk. What risk? Price risk. Yeah, so that is all about price risk. So objective behind this mechanism is to offset the loss in one market with a gain in another. And you might remember that I've been talking about this all along. So one market with a gain in another. Which are the two markets? Spot market and the derivative market. So you design strategies. If you make money in one market, you lose money in the other. And I will show you some examples of hedging strategies now. So look at a long hedge. You don't have to be worried about names. Long hedge basically just means that I'm buying the contract. So if I buy the contract, I'm going long. And the strategy, if it's a hedging strategy, we call it a long hedge strategy. If I'm selling a contract, we call it that I'm going short, or it is a short hedge strategy. So it is all about whether I'm buying a contract or selling a contract to hedge a position. Now, if I'm buying a contract, it's called a long hedge. So let's look at this particular example that I'm going to talk about now. Here is an example where on the 1st of August, somebody wants to buy gold. He buys a gold futures contract. Why is he buying the gold futures contract? Because he thinks that the price will go high. So he buys a gold futures contract. And on the 15th of October, he sells the gold contract. And the difference between the buy and sell would be his profit. And whatever the profit is, in the physical market, if the price of gold had gone up, then he would have ended up buying at a higher cost than he would do if he had bought it on the 1st of August. Because he did not buy it on the 1st of August and at a low price, now he thinks that he may have to buy it on the 15th of October when he actually needs it. And this might, it will imply that he may have to pay a higher money because he's expecting prices to go up. Now, this extra price, he could have avoided by buying it in the physical market and keeping it in the warehouse or in a vault because it is a gold. But if he had kept it in a vault, he would have ended up having holding costs. But to avoid the holding cost, what he does is he buys the futures contract. And if the price goes up like he had anticipated, then if the price goes up, then he makes money on the contract. And then that little extra money he has made here will help him to take care of the extra cost that he would have suffered if the price goes up. Now, let us look at what happened here in numbers. Now, on the 1st of August, in the spot market, the price is 46,186 for a 10 grams. Now, he could have bought at this price. He does not. Why does he not buy? Because if he buys it, then he needs a place to keep it and he will suffer holding cost. Instead, what he does, he buys a contract. He buys a futures contract. He buys a futures contract at 44,842. And then on the 15th of October, when he actually needs the gold, he sells the contract and the price has actually gone up. So he's made money. He's made 2,360 every 10 grams in the futures contract. And then he goes to the spot market and buys the gold at 47,900. How much did it cost him? It costed him 47,900 in the market, less the profit he made in the futures. So what was his net cost? His net cost is 45,540, which is even lower than that particular cost. And this is what we mean by hedging. But is this a hedge? It is only 50% of hedging. Why do I call it a 50% hedge? I call it 50% hedge because I'm assuming that he got it right. He thinks price will go up and the price has gone up. What if the price had gone down? If the price had gone down and not gone up, then what would have happened? He did not buy at 46,186. He bought the contract at 44,842, but the price has gone down. It has gone down to 44,300. So he squares up his position at 44,300, suffers a loss of 542 per 10 grams on the futures contract. Then he goes to the market and he buys the gold at 44,900, the going price on the 15th of October. How much did it cost him? It costed him 44,900 plus the 542. So it costed him 45,442. But the point of the matter here is that what has he done? What was the objective? The objective was about managing risk. Now, he managed risk by buying a contract and didn't matter. He didn't bother whether the price went up or the price went down. Whichever direction it went, the price was approximately in a reasonable range that he could tolerate. And this, ladies and gents, is what we call by hedging. Hedging, where I'm pitting one market against the other market, futures market against the physical market, in such a manner that I don't make a big profit, but I don't make a loss either. The aim of the strategy is to manage my risk. I know that some participants are raising hands, but I'll take the questions in a few minutes because I must end. I've got something on short hedge. What exactly is a short hedge? Is this again a strategy? It's a strategy where I'm selling. What am I selling? I'm selling a contract. Now here it could be a position. For example, in this particular example, I've taken a position where someone already has an inventory on hand. In other words, he already has the commodity. He has bought it, but now he's frightened that the price might fall. This is a gentleman who's frightened the price might fall. It could be somebody in the pandemic, someone who bought gold and he now thinks that the vaccine might come, and because the vaccine will come, the prices might fall. So wherever the prices have fallen, they will rise. Where they've risen, they will fall. So he's frightened the price will fall. So what he does is he sells the contract at the high price. And later on, he buys the contract back. So let's see how this works. So he is anticipating prices to go down. Now he has at 46,850, he has already got this in his inventory. Now he thinks price will fall. So what he does is he sells the contract at 46,900. By the way, just remember that when he sells a contract at 46,900, how much money does he require? He only requires approximately 5% of that value. So he sells the contract at 46,900, okay, by paying only 5% of the contract value. And on 31st of October, he buys back the contract at 45,700. The difference between the two is his profit. So he makes a profit of 1,200. So how much did it cost him? It costed him 46,800, which he has already paid for, is lying in his vault. Add to it, oh, and here he has got 1,200. So he has, okay, so I think I got this wrong here. He has bought the, he has, just give me a minute. What has he done? He has already bought this contract at 46,850. So he makes a profit of 1,200. So he subtracts this 1,200 from this 46,850. So his actual cost is 45,650. So what has happened is he had bought at 46,850 lying in his go down. He makes a profit on the futures contract of 1,200 rupees. So his actual net cost is 45,650, which is in line with the cost on the 31st of October. But remember, this is 50% of the hedge. Why do I call it 50% of the hedge? Because what if the price had not gone down? What if there is no solution to the pandemic? What if the price of gold continues to go up? In which case, let's see what happens. He has already bought the gold at 46,850. He has sold the contract at 46,900. He buys it back at 47 because the price has gone up. It did not go down as he had anticipated. It continues to go up. He makes a loss of 250. So what is his cost now? His cost is 46,850 plus the loss of 250, and hence it is 47,100. So the point of the matter here is, remember, he's not trying to make money. He's not trying to lose money. His aim is to lock into the price. And of course, he could have even avoided this 250 loss because we have free entry, free exit. And if he has seen the price rising, then maybe he wouldn't have had to wait till 31st of October. On the 29th of October, 26th of October, 25th of October, when he sees the price going up, he could have squared up the position and even avoided that particular 250 loss. This is what we call, when we talk about hedging. And this is the primary reason why commodity exchanges are there, so that people can manage risk. So what is the benefit of hedging? The benefit of hedging is you lock into prices. You ensure better cash flow management. Because if I'm buying something in December, I don't need the money now. I can negotiate with banks and borrow at better terms. If I'm somebody who is borrowing money to buy the raw material, and then I make them finished goods and then sell it in the market. And then when I get the money from them after sale, then I can pay back the loan. And hence I can have better terms if I'm borrowing money. So I can ensure better cash flow management. It's like insurance against price risk. So whatever, I'm not bothered about which direction the price will move. I've already insured against that risk of movement. There's better inventory management. I can do better inventory management. I don't need a warehouse. I don't need a vault. I can manage my inventory better. I don't need to carry a lot of inventory. And I can focus on the core business activity. I don't have to waste my time. Should I buy now? Shall I wait for one more week? Maybe I should wait for next month. Maybe the price will go down. When should I buy? And the seller is also thinking in the same terms. We don't have to do that. If I can just concentrate on the core business activity, that is the benefit of hedging. It helps better functioning of industry. So important points. Possible commodity price risk. I think we know what are the different types of price risks which are there in the commodity markets. Every commodity has got something to talk about. And especially when it comes to agriculture commodities, you can have some commodity specific price risk. Like for example, you have the pink ball worm, which attacks the cotton plantations. Yeah, that is also causes risk, because if there's a destruction of because of this pink ball worm, then there'll be a shortage of supply. Similarly, you have seen that in Kerala, in the state of Kerala, 1.5 years ago, there was so much rainfall that it affected the cardamom plantations. Yeah, the cardamom crops got destroyed at that time. Similarly, this beginning of this year, we have seen because of rainfall in Gujarat, cotton was affected. In some areas, cotton got affected. We also seen other kind of things like, we have seen this attack by these grasshoppers, or whatever you call them, locust attack, which have had an impact. Of course, they managed to control it very quickly in India, but it did have an impact on price moving up and down. So there are a lot of things which have an impact. Next thing is about differentiate between hedging and speculation. I think now we know what hedging is and what speculation is. Speculators bring liquidity to the market, so that every time a hedger decides to enter the market, there is a speculator who is willing to take the risk. We also have benefits of hedging. In the last slide, I've explained to you what are the benefits of hedging. Do remember, commodity markets are there mainly for hedging. So who are hedgers? Anyone who is connected with a physical commodity. It can even be an importer or an exporter. An exporter who buys the physical product locally and he sends it abroad. He wants to sell it across to some other country. During the period when the commodity is in his possession, he is susceptible to price risk, and he too can become a hedger, right? There was dabba trading. Dabba trading is when people do illegal trading. We call that dabba trading. Yeah, and it's illegal. It is what we call criminal, and it is a jailable offense. Dabba trading is when people get together and trade amongst themselves, bypassing the government or the taxation department. Okay. So commodities that we have on exchanges, we have precious metals like gold and silver. We have crude oil and natural gas. We have aluminium, brass, copper, leads, nickel, and zinc. We have agri like mentha, cardamom, cotton, crude palm oil. We have others as well, which I have not listed here, like natural rubber. Mentha oil is your pudina. Pudina is used in making mentha oil, which is used for creating the mint flavored toothpaste or the mint flavor in Polo mint flavor cakes and chocolates. That all comes from Menta. India is the largest exporter. We also have options. We're going to talk about options in the afternoon. We have option contracts. We got mini options contracts. We have silver mini options contracts. We also have this MCX iComdex index futures. Now this MCX iComdex index futures is an absolutely brand new commodity contract, which is yet to be launched. It is going to be launched on the 20th. Index futures. Index futures is like your Nifty or your Sensex, where you can buy the Nifty or you can buy the Sensex. You're buying the what we call the index. You can trade on the index, and hence for the very first time at the MCX, we are launching index futures on the 24th of August, next week. So we got options contracts. We're going to talk on options in the afternoon, so I won't talk much now here, but I just want to tell you that we have various contracts which are traded on commodity exchanges. And we got a regulatory viewpoint here. We have a SEBI. Under that comes stock exchanges. Under that comes members, and then comes clients. So when anybody wishes to trade, you are the client of a member, and the member can be any of the broking firms, or it can be one of the bank security companies. They are members of exchanges. So you have ICICI Bank, ICICI Securities or HDFC Securities, Yes Bank Securities, or you can have these Anand Rathi and Sher Khan and what have you. These are all members of the exchange. So if anybody wants to trade, you become members, you become clients of these members, just like you do in the stock markets. And these members they are answerable to the stock exchanges, and the stock exchanges like MCX is also called a stock exchange because we also report into SEBI, and we report into SEBI, and SEBI is the ultimate regulator. Now with that I end myself, but I will be taking questions now from you. So questions? I would appreciate it if somebody reads out the question so that I can answer it.
Sir, thank you, sir. I will ask the participants to raise the questions.
Okay.
Hello.
Yes.
Sir, Nagarjuna, sir, please ask question to.
Yes, sir. Good afternoon, sir. Good afternoon, sir. This is Dr. B. Nagarjuna from Sri Vidyaniketan Institute of Management.
Okay.
Sir, thank you for giving a wide insights into these derivatives, commodity derivatives.
Okay.
I need a couple of clarifications from your end, because basically derivatives is a huge subject.
Okay.
My question is also a little bit lengthy. I request the organizers to give at least 1 minute time to put the question to you or clarification from you.
Okay.
It is related to what impact the COVID-19 pandemic has created on the derivative market, because basically people have been using the term post-COVID-19. So we don't know when the world market is going to become free from this pandemic. Now we are in the month of August. And as you told in your presentation, it all depends upon the perfect information that is available for the traders, particularly how we perceive how the things are going to happen. Only with a reliable vaccine that is going to be released by Oxford University, the pandemic will get a solution. So now my question is, do we need to keep this in mind, particularly the traders when they deal with commodities in futures and options, because the decision which we make today is for tomorrow. So hoping that the vaccine may be invented by December 2020, I make a decision in August 2020 by entering into some option contracts or future contracts and certain very demanding commodities now like ginger, turmeric, garlic, onion, pepper, etc. What do you say? How the impact of COVID-19 is there on this particular segment? I hope I am clear.
Yeah, I'm very clear. Okay. Now, there are two things here. One is on the commodity exchange. I'll take the last part of your question, where you mentioned turmeric and ginger and garlic. These are not traded on commodity exchanges. Okay, so if somebody wants to manage risk or price risk on these commodities, they will have to find some other way of managing risk. So if you want to manage a risk on a commodity exchange, you will have to find an exchange where these commodities are traded. Only then you can you can have a hedging strategy there. Okay, that is the first thing. The other one is about your the impact of the pandemic. Now, pandemic has had an impact, no doubt about it. But you'll be surprised to learn that other than in the initial stage in the month of April, where everybody was suddenly sitting at home and they didn't know how to react to the new kind of working atmosphere. We have now seen that the volumes on exchanges have gone up significantly. Okay, we are seeing huge volumes on exchanges. Now, when you're talking about huge volumes, there are two things happening. One is because of the ease of trading, many people are trading sitting at home. That's one. The other one is because people are anticipating price movements. I'm talking about the users of commodities. So we can now be assured that there are more hedgers coming to the market to take care of their positions, because people have understood that hedging takes care of different types of risks, price risks, okay, including regulatory changes, or it can be, of course, like I mentioned, rupee dollar convertibility and things like that. All this kind of thing has an impact, okay, on the prices. And the price, once you have the impact on the price, and whose idea is it about the price? It is the market. So each individual who's trading on the market has got a different perception. And because it is a very flexible and open market, everyone is viewing everyone else's position and redefining his own position and taking a buy or a sell position on a commodity market. So what is happening here is that we are looking at, on a commodity exchange, everybody's ideas come to a summation point of a price. Now, like I said, the minute we are talking about a solution to a vaccine, by way of a vaccine, by having a vaccine coming out maybe this month, next month, we don't know when it'll come out. The Russians have said they already have a vaccine. Others are saying we don't know. Now, what it does is that it will change the market totally. There's no doubt about it on my mind. In other words, if you're finding prices collapsing right now, you'll find the reverse happening when market starts taking off after the once we have found the virus, the vaccine for the virus. And every time there is an announcement that some breakthrough is near or possible, it immediately has an impact on the rupee dollar convertibility. You just have to watch. I want you to, all of us who are on this program, please watch the rupee dollar value every time there's an announcement of a supposedly discovery of a vaccine. Okay, we still don't know. So even though they're doing some research, they're doing at different stages of research, we don't know the final outcome. But the minute there is some solution to this, you will find that the industry will again open up in a very big way. And all the countries which are in a recession right now or getting into a recession right now, they'll start coming out. And when countries come out of a recession, the first thing they do is that they revive their economies, and which means the price of raw materials will start going up. Now, if you are taking a position on commodity markets on a contract, you are very beautifully positioned, because you can take a position and you can reverse a position at any time. The minute some information comes, you are at the absolute, you have the, what we call, I explained in one of the slides, that very efficiently placed to take a reverse position the minute you find that the markets are moving in another direction. It is not like a OTC derivative. In an OTC derivative, whereby a buyer and a seller have contracted to buy or sell in the future, they are locked into the price. Whatever happens, they are stuck with the price.
Yes, people have to attend any of my lectures.
Okay, all right. I hope I can, because your questions were very lengthy, so I was not. I hope I addressed part of it. Can we take some other questions?
Hello, sir. Good morning, sir.
Good morning.
Sir, on behalf of the participants in chat box, some of the questions we would like to pose to you, sir. One of the question is asked by Dr. Bharatraj Shetty.
Okay.
Commodity market is not as popular as share market. Okay. Do you think in future, due to changing scenario of lot of thrust in the agricultural sector, can commodity market will boom?
Okay. Now, there are the various ways I can take this question. One is that it has been very clearly informed that the government wants to make the Indian financial sector, make it at par with the Western financial markets. In that endeavor, you just have to watch what all new things have happened in India in the last 2 years. The regulator for commodity markets is SEBI. SEBI controls the commodity markets. So what have they done? One, they have introduced commodity derivatives, which was never ever there in the past. Yeah, so commodity derivatives were never ever there in the past. They were introduced about 2 years ago. Then other thing they've done is that they are looking at more commodity contracts in the market. So the new contracts which are coming into the market, they have they've broad-based the market by allowing for new categories of players to come in. Banking segment was never allowed in the commodity market earlier. So subsidiaries of banks have been allowed to come into the commodity markets to wide-base the commodity markets. Mutual funds were never allowed in the past. Mutual funds have come into the market. So the point here is the regulator has been doing many, many things. They've even allowed category 3 IF, that what we call hedge funds. Hedge funds from category 3 hedge funds have been allowed to come and hedge in the Indian markets. So the point here is that we are doing everything that the market is going to grow. Now, when you talk about the size of the market, we are doing something like on an average about 35,000 crores of business. 35,000 crores of business every single day. That is the volume on the commodity market. And it is only bound to grow. There's no doubt about it. It will grow. And when you talk about agriculture segment, in agriculture segment, there's lots to be done. Agriculture segment, unfortunately in India, has not come of age as of now. When I'm talking about from the derivative trading point of view. And there's lots to be done. And it is being done. And you will see that more and more contracts in agriculture will come. In fact, just to tell you that agriculture segment, derivative segment in India is the smallest segment, the biggest being the bullion segment. Okay? Whereas in the international markets, the biggest segment is the agriculture segment. Okay, so we are trying to become like the Western markets. So we have to make the agriculture segment the biggest segment, and it will happen. It's a question of time. One of the reasons why we have not got there is because of the lot of effort is happening here too. Okay, we are doing lots of things are happening. The regulators are doing many things. They've created FPOs, farmer producer organizations.
Futures. Are these more risky?
Okay, now the index futures, which will be launched on the 24th of August next week. Now this
single index futures, sir.
Now actually we don't have a single index. We don't have a futures contract on single index. It's a 2 commodity index. Okay, index futures is a contract, a futures contract, which will be traded on the bullion index. The bullion index is a summation of single commodity gold index, single commodity silver index. Both of these will be combined to create the bullion index. And on this bullion index, we will launch a bullion futures contract. So you trade on the bullion futures contract. Yeah, the underlying will be the bullion index. Bullion index is based on single commodity gold and single commodity silver indices. So that is what it is.
Thank you, sir.
Yeah.
Another question from the participant, Dr. M. Sukanya, madam. Now I will unmute her.
Yes, madam. Hello.
Hello, sir. Good morning.
Good morning.
Sir, one small doubt is that if the future market, when you enter, future contract,
correct.
Suppose if the buyer wants or a seller wants to withdraw, can he close the contract before the expiry of the date?
Absolutely. That is why I said about free entry, free exit. Okay. So if I buy a contract, within 10 seconds, I can sell the contract.
Okay,
I can sell. Yeah.
So within the expiry date, you can.
Yes. Any time between today and the expiry date, I can do multiple times. I can buy, sell. So in the morning, I can open my laptop or my mobile. I can sell a contract, have a cup of tea, then buy the contract, and I'm out of the market. The difference between
Thank you, sir. One more doubt is, as you said, the margin price, margin percentage, 5% and all, 2%, 5%. Is it dependent on the size of the contract or standardize of the contract?
No, the margins for that we'll need to a separate session. Really, margins are I'll explain to you. Basically, the margins are based on risk parameters. They are based on something called VAR, value at risk. It's a statistical tool. Yeah, value at risk. So basically, what VAR does is it looks at price volatility over, say, the last 200 days, and it knows as to how much a price can vary in one single day. Yeah. Based on historical price movement. And hence, when we say 5% margin, what basically 5% margin is saying is that if price moves by, say, it cannot move more than 5% because the VAR is saying the price cannot move beyond, say, 3%. So if you have a 5% margin, if there is a movement of price of 5%, that is the amount of risk that the exchange is bearing. But exchange is not bearing that risk either, because exchange has taken that money from you. Exchange has taken that 5% from you and just blocked it in your account. So if a person is not happy with that contract because of the price movement, he can always exit the contract.
Okay, he'll be losing that margin price?
No. Margin money is only for risk management purpose. Margin money is always refunded to the person. So if I buy a contract now and if I sell the contract later on, the 5% which is blocked will be released in its entirety.
So clearinghouse will take care of that.
Clearinghouse will take care of that.
Thank you so much, sir.
Thank you, sir.
Information.
Yes.
Thank you, sir. Another question from Pallavi, madam. Now I will unmute her to answer the queries. Madam, Pallavi, madam. Pallavi, madam.
Yes, sir.
Please ask the question to.
Good morning, sir. I am Dr. Pallavi from Visakhapatnam, sir. Sir, I have a question regarding what research opportunities we are having in commodity segment, and is there any provision for funding from MCX, sir? As an academician, I'm asking this question.
Okay. Now, the thing is, there is a list of 91 commodities which has been decided by the regulator. 91 commodities. These are commodities in which an exchange can decide to launch a contract. Okay. Now, in addition to this list, if anybody wishes to launch a contract in a new commodity, then there is scope for research. In other words, to be included in that list, the SEBI list of 91, can be research done to say that, hey, here is a particular commodity. It has a lot of scope. Research can be done to the conclusion should be or would be that here is a commodity which will benefit the buyers and the sellers if it is there for trading purpose on a commodity exchange. So research can happen that way. Okay. Now, a lot of research is done by exchanges as well. Yeah, exchange sometimes helps others, by providing some funds to carry out the research, and also exchange itself carries out research. Some of the government agriculture universities, they carry out a lot of research, and they're doing it on behalf of the ministry or for governments. They're trying to do research to find out if there is scope. But yes, MCX as an exchange and other exchanges do have to do research. It is mandatory that if you are coming out with a new commodity for launch, then it must be backed up by research. We can't just pick up a commodity out of the hat and say, here, let us design a contract. It doesn't happen like that. It is for launching any commodity, it has at least 2-3 years of research backing, and it has to be placed before lots of committees who would finally decide whether there is any scope for launch of commodity contracts in that commodity. Can you go to the next question, please?
Sir?
Yes.
There is a question from Venkata Durgarao, sir.
Yes.
Now I will unmute her. Please answer, sir.
Yes, sir. Sir, good morning, sir. Srikanth, sir.
Yes, good morning.
Yeah, you have given good presentation, sir. It's very informative for academicians. Sir, I'd like to ask one or two questions, sir, if you permit me.
Please, go ahead.
Sir, what kind of suggestion you may give for the new investors? See, I am in academic field, being a assistant professor or associate professor. I would like to invest in derivatives market. So, what kind of suggestion you will give? And one more question, sir. My friends are also doing derivatives business, sir. Like they have started from broking by taking some others' help or something else. They have been doing this business, and most of the time they are getting losses. They have been telling me whether it is right or wrong, I don't know, but they are saying that we are getting landed up in losses. And how you can that means what kind of suggestions you give to the new investors like us?
Okay. First of all, if you're a student, I always tell students, finish your studies first. Okay, right? Before you get on to trading. Okay. Next, if you're new, then you pick up contracts which are small in size, very small size contracts. Okay. Third thing that you need to do is that there is a lot of hand holding required when you first trade, at least for the first couple of days. And you need to understand the commodity thoroughly. If your friends are making losses, that means they have not understood the commodity very well. So you need to understand the commodity, the fundamentals of the commodity. Then commodity market is not like your stock market. Commodity markets are very, very specific in nature. So if you pick, you can't jump. Like in stock markets, you can jump from one commodity to another commodity. Yeah. Sorry, in one stock to another stock. Here, you pick a segment and be sure of everything in that segment. You should know, for example, if I pick copper, then I should know which country produces the maximum copper in the world. I need to know what are things which can impact the price of copper in that country. I need to know who are the major buyers of copper. You understand what I'm trying to say? The fundamental analysis of that commodity. And then I need, the first thing is, once I know, and this can be done by anybody. You just need to keep a record of things which impact the price of a particular commodity. Next thing is about getting information, because now you know what is impacting the prices. Next is you need to know information. And it's not just about getting information, it is getting information quickly. The one who gets the information the fastest has the ability to take a position, the correct position. Yeah. And hence you must ensure that you have source of information, various sources of information regarding that commodity in which you're interested in. Okay. And finally, when you trade in a commodity which is small in size. Yeah. So for example, on MCX, we have a petal contract. It's called a gold petal contract. It's a 1 gram contract, very, very small size. Yeah, of course, today's date, 1 gram costs 55, 1 gram costs 5,500 rupees. Yeah, okay, about 5,000 rupees, you can say. And if you're trading in that commodity, then you need about approximately 5% of 5,000 rupees. That is very small amount of 225 rupees or whatever you need. Yeah, so that is the amount of margin money that you need to take a position. Okay, now when you trade, other thing you need to do is that you find the broker who will be giving you the right advice. Now, that's important. Next is that you ensure that the broker is a member of the exchange. Make sure that he's not a sub broker or someone who's got an additional line or something like that. Make sure he's a member of the exchange, right? And only then you'll be very clear what he's doing. So you need to have all these checks in place, and do not get carried away by tips and market news. There are a lot of people who will give wrong information in the market because they want to exit their position. So you must be very aware of what information is relevant, what is not. Even now, sometimes we come across information saying that vaccine has been found, and the market starts moving, and then they say that, oh, it's in the second stage. Okay, and so on. So the point of the matter is there's a lot of misinformation also. And it's not just limited to stock market. It is not limited to commodity market. It's there in stock markets too. So we have to be very, very careful as to how and where I'm getting my information from. Okay.
Thank you, sir.
Thank you, sir. Thank you.
Thank you, sir. Now I request the participants to send their queries to the email, and sir will answer you because sir need to attend next session in afternoon.
Yep.
Thank you. Now I hand over. Now I ask our coordinator, sir, to give the message. Sir, Sudarshan, sir.
Oh, okay. Thank you, Balaji.
Sir.
Srikanth, everybody enjoyed a lot with the subject, sir. Galaxy of subject you presented before the participants. We are all enjoyed. Let us meet at 3 o'clock once again for second session. Okay, sir. Thank you very much for first session. Simply saying thanks to you is not enough.
No, that's
not enough.
No.
But it is a mandatory part to tell thanks. Okay, once again, sir. On behalf of my institute, I am telling you thank you very much.
Thank you, sir. Thank you, sir. We will meet again in afternoon sessions.